Hey everybody, welcome back to Taking Trades. Welcome back to the channel. Happy Wednesday to you. We got a lot to talk about today. We're going to dive into the weather because there's been a slight change. That's number one on our list. Number two, we're going to jump into UGAZ and DGAZ. We're going to review the charts. We're going to talk about the technical levels again and specifically look at what happened in today's price action. Then number three, we're going to talk about an amazing options trading resource. I've had a lot of comments recently about trading options and having more content uploaded regarding options trading. So I want to give you a free, completely free resource that is amazing, and it's a wealth of information that can take anyone from a beginner all the way to a high-level elite options trader. Everybody can benefit from it, so I'm going to share that with you today. And number four, I'm going to show you an options trade on natural gas that you can take in this environment because of a specific metric called volatility. We're going to touch on that briefly. I'm going to break out the whiteboard, explain it just a little bit so you have a quick visual of what volatility is and how you can put volatility into play against natural gas in your favor right now. So with that, let's begin. All right, you knew it. The first place we were going to go is natgasweather.com. I just want to give you a quick update on what's been going on and why we had that pullback today. And it's due to the weather. And I think the most valuable at quick glance piece of information on natgasweather.com is to just come to the image of the day right here, scroll down right below it, and just read this paragraph. It gets into talking about what happened yesterday, and it's just saying that natural gas futures rocketed higher on Tuesday, closing up 11 cents. They went as high as 16 cents, up and over 250 for the midday, and then they talk about how the GFS added a massive 30 heated degree days, and that's what caused that push to the upside. But then when the afternoon European model failed to back that up, prices retreated by a nickel. Then came the overnight GFS that lost nearly all 30 of the heated degree days that it had gained on Tuesday by showing not nearly as much cold air across the northern US. Prices quickly dropped several cents on the milder overnight GFS and then continued a few more cents lower when the European model also wasn't as cold and lost 5 to 6 more heated degree days. So with all that being said, this final sentence tends to sum it up the best. It says, so big forecast swings in weather models continue and prices have been getting whipsawed the past 2 weeks as a result. So I think what we're getting is we're getting changes in the models. No one knows, is it cold, is it not? When they put out a forecast, you get a big pop, but then when reality comes in and maybe it's not as significant, you get the pullback. So it's all kind of dramatic and kind of wild how these models, including the European model, shifts the focus and causes ups and downs in the market. So come to natgasweather.com, look at the image of the day, scroll right down to this paragraph, read this. It'll give you an exact to the point reason as to why we're seeing a pullback in price, and then you can move on from there and make your decision. So that's about all I have for weather right now. Let's dive into the charts. All right, I've got /NGF20, which is the January futures contracts chart. I've got it up on the daily time frame. And let's just take a look at what happened today. You can see right here, we had that big push back to the upside, got rejected by that overhead resistance level. We talked about this in yesterday's video, and then we got rejected further today. This is because the confusion over the different models, the European model not backing up exactly what was happening. We eliminated heating degree days, and now we're getting a little pullback here. It's not crazy violent. It's not pushing below the lows from yesterday, so that makes me feel a little better about it. And if we flip over to the 5-minute chart, you can see we've been trending downward, and you can see when we kind of went after hours and we got into Wednesday, early hours, we kind of did a whole lot of nothing, and it's just been sort of back and forth. And if I draw out, really a couple ranges here, you can see that overall today, we've really done a whole lot of nothing, just a bunch of up and down. So not much going on today. I think there's some confusion in the market because of the heating degree days that were eliminated after the confusion about the cold weather not being supported. So let's go back to the daily chart real quick. And again, just want to quickly touch on UGAZ. I want to take a peek at that, and then we'll look at DGAZ as well, just checking them out to see what the support levels are looking like. So today we got the gap, or yesterday we got the gap up, pushed up higher, and now today we got the gap down and we're just sort of hanging out. So not a lot of movement at all today. It's going to be very dependent, almost day to day, on the weather and what the forecast is. I want to reiterate that if we get a forecast of cold weather and we get a pop, you got to take some profit because you don't know how long that will last. If the next day another forecast comes out and things are not being backed up and it's a little warmer than originally anticipated, it could pull right back on you and you could lose profit because you didn't take any money off the table. So just be aware of that. Now jumping over to DGAZ real quick. Let's take a look at this one. So we're getting DGAZ gapping up a little. Small doji green candle. Looks like we got rejected off this overhead support level that we drew in a while back. And just a lot of nothing there as well. So I think today is just going to be a hold and wait and see what happens. The futures look like they've bottomed and they're having a little bit of buying pressure pushing it back up. Currently trading at 2.387, which is a lot better than 2.27 like we had down here. So we will definitely take that. That's about all the chart action we have for today. But I want to show you guys an additional way to make money in natural gas trading options that does not involve UGAZ or DGAZ. I touched about this in a video a while back, and I want to reinforce it because you can just add a little more money to your pocket trading options on UNG, the United Gas Fund. So I want to get into that and walk you through exactly what I'm talking about. But the first thing I want to do is I want to jump over to the whiteboard and I'm going to show you what volatility is. And I have a simple schematic that I drew that I want to show to you just to help make this make sense. And if you have any questions about volatility, drop them in the comments below and let me know. So with that, let's jump over to the whiteboard for a second. Explanation of what volatility is and how you can use it to trade options. So let's look here. So volatility, we've got, this is our topic of the afternoon. We've got a large circle here relative to this one with some dollar signs in it. Then we have a smaller circle with a dollar sign in it. So the way to think about volatility is that it's simply fear in the market. And I'm actually going to show you a chart where you can actually go and look at volatility to see if it's up or down. When there's more fear in the markets, volatility expands like a balloon. Picture this as a balloon full of money. When there's fear in the market, there is more money to be made in options premium. Now, what I mean by that is when you go to the options chain, which I'm going to show you in a moment, you can sell premium against these options positions and make more money right now because volatility is high. Now, the idea behind the options trade is to engage in the contract, set it up when volatility is high, and then as volatility contracts and gets smaller, then there's less premium available, and what you can do is you can buy your position back for a cheaper price. So let's say you get paid $5 per share for 100 shares. So you got paid $500 to sign the contract, to engage in this options contract. And you have to wait 30 days to expiration. Now let's say on day 10, your volatility drops and it cuts in half. Let's say it's half of what it was here. Let's say it's 50% here and it's only 25% here. Well, what that means is in order to close your contract early, which would be called buying it back, you're selling option premium here and you want to buy your position back to close it, you can buy it back for a cheaper price. So let's say you get paid $5 to take the contract, and then because of circumstances and because of decrease in volatility, let's say in 10 days, you can buy it back for $2.50. You could just go 10 days, close the position, and you keep $2.50 once all of it's done because you got paid $5 up front, which you always keep, that never leaves, but then you pay $2.50 to close the position out. Volatility balloons up when there's fear in the market and brings big premium values. Then when volatility shrinks, when there's not as much fear in the market, premiums go back down. So you get into the contract and take money here, you sell premium for $5, but then you want to close your contract early and take some profit and get out, you can buy it back for $2.50 or maybe $3. Or maybe you get really fortunate and you can buy it back for $1 and you keep $4 of the dollars. Or you wait all the way to the expiration and you keep all $5. But the nice thing is, if you sign up for a 30-day contract, an options contract that's a 30-day expiration, if after 10 days you have 75% of the gain because volatility has contracted so much and you can buy it back for only 25% of the original cost, then you can collect that money quickly and move on to the next trade without having to wait out all 30 days. So this schematic was just meant to demonstrate that when volatility is high, selling premium in options contracts is rich. As you move forward and volatility gets smaller, option premiums are not as rich, so you can buy to close for a cheaper price and overall come out ahead. So with that, let's jump into ticker UNG. I'm going to show you the chart and the options chain and demonstrate a little bit of how you might set this up. So let's jump over. Here, I've got a chart up on something called the VIX. And you can see right here, this is the volatility index. And I was telling you I would show you a chart where you could go check out the volatility. You could see if it's high or see if it's low. And I just want to show you just simple, just basic, so that you know that it exists, and then we can continue to learn about it as we upload more videos. But you can see recently we had a nice push up in volatility. So as this moves up, premium balloon grows and premiums become better. So someone who wants to sell puts or sell calls, any premium sellers in the options world will be making more money when the volatility is higher. Now you can see it's pulling back today, but it's still quite a bit higher than it's been. It's been clustered very low recently. So now that you've seen this and you understand that volatility is up a little bit, let's flip over to UNG, which is the United Natural Gas Fund. And I want to show you a way that you can make additional money trading natural gas without trading UGAZ or DGAZ. Hang on one second, I got something to mention to you real quick. If you're looking for an awesome broker and an awesome platform where you can get lots of information based on options trading, check out tastytrades.com. And they have a brokerage platform, a trading platform called Tastyworks. You can go to tastyworks.com and you can check them out. They have a ton of videos, a ton of educational materials. They do a very good job of educating the beginner all the way up to the expert options trader. And it's all free. Everything that they do is free. Their platform has fees on it for options contracts, but a lot like the other platforms now, trading stocks and things are free with zero commissions, but it's a great trading platform, a great team, and a great educational resource. And I'm lucky enough to have a referral link in the description. If you click that referral link and you sign up for a Tasty Trade account at Tastyworks and you fund that account, it'll support this channel and I really appreciate it. All right, let's get back to it. So right now we're looking at this, and if you go to the Trade tab, you can open up the options chain. And the first thing I want to point out, and I'm going to move myself over here, is that this section right here under today's option statistics right here, if you open that up, you'll see different percentages. And this is where I go to make sure that options premium is going to be high. I want to make sure that volatility is in my favor before I sell any premium on an options contract. And the thing you want to pay attention to is implied volatility right here is 56%. Now, what you want to think about is that 56%, what does that mean? Well, if you look at the IV percentile, it's also 56%. And this kind of worked out funny. It usually doesn't work out this way, but 56% volatility, if you plot that on a chart for the last year on UNG, this is about 56% for the past year of where it's been. So let me show you, let's just look at a different one real quick. I'll show you Tesla just to give you a better example because that usually doesn't end up that way. So right now, Tesla's implied volatility is 41.63%. But when you compare that to where Tesla has been over the last year, it's actually only 8% of where it's been. So 41%, which seems a little higher, is actually only 8% for where it's been in the last year. So that means that it's been 92% higher than 41%. And I know this sounds a little funny and it'll make sense as we keep talking about it, but 41% volatility for Tesla is only 8% of where it's actually been in the past year. So that tells you it's been much higher than 41% because 41% is only 8% of what Tesla has traveled in the last year. So if we go back to UNG, now that we know that volatility is higher, and one rule of thumb is that I like to find this current IV percentile, which is basically comparing volatility against itself. As long as this number is above 30%, that seems to be pretty good for seeing volatility and seeing premiums being higher. If you get one that's 100% or 80% or 90%, that's really great. But UNG is at 56%, which is a pretty good IV percentile. So what I'll do is I'll come in here to the options chain, I'll pick out 30 days right here roughly, and I'll just jump in and take a look at it. So what we can find in here is that we'll go to the put side, and the reason I'm on the put side is because natural gas is low, and the likelihood, in my opinion, is that it's going to move higher at some point because it's at historic low levels. So I'm more bullish on it right now. So I'm going to be looking at a put option. And the put option being, I'm making a bet that I don't think natural gas is going to go lower than a certain number. And that number would be my strike price. So let's say I pick out and I say, I don't think it's going to go lower than 1750 in the next 30 days. 1750 would be my strike price, and I would get paid somewhere between 66 cents and 77 cents per share on my one contract, which is 100 shares. 100 shares makes up one contract. So let's just say it's 70 cents, somewhere in between the bid and the ask. 70 cents on 100 shares. So I would get paid $70 to take this contract. Now, if we take our 1750 and we come out to the chart, what that would mean is if I plot a line right here at 1750, that means that in the next 30 days, I need UNG to stay above 1750. As long as it stays above, I keep my $70, the contract expires, and I move on to the next trade. If it goes lower than 1750 and it expires below, then I will be responsible for purchasing 100 shares of UNG at 1750, regardless of how low it may go. Even if it's down at 15, I still have to buy it at 1750. So my goal is to have it be above that. So when I'm looking at this options chain, the probability that it's not going to go below my strike price of 1750 is about 60%, you can see right here. They would call this a 34 delta put. So we'd be selling a 34 delta put with a 60% probability of staying what they call out of the money, meaning above my strike price, and I would get paid about $70 to hold the contract. So as you can see, this is a great way to be able to just earn extra money on natural gas, in and around natural gas, without trading UGAZ or DGAZ. You know, maybe the 3 times leveraged ETFs are too much for you. Maybe the swings are too big, and you just say, you know what? I want to consistently make $70 a day or $70 a week. Or if you want, you can always come in here and you can set it up and you could sell 2 contracts and you'd get 70 cents times 200 shares, which would be $140. So you can just keep scaling up and adding contracts. Now I will warn and say that it's very important and smart to trade small and trade often. So trading different products, different things, but keeping your size small. You don't want to sign up for 10 contracts and go at it, because if something goes wrong, you're in real big, and that can show a lot of risk to the downside. So you want to be careful on your size, but this is a great way to say, okay, I'm going to watch this each day, and even if as price moves, you want to keep selling additional contracts on UNG, you could be selling them at different strikes. Maybe it moves up a little bit and you decide to sell one at $19.50. Or it moves down, you decide I'm going to put one on at $15. Just depending on where the price currently is, you can kind of ladder your options contracts as well. But this is just a great way to add a little more diversification to your approach with trading natural gas, and it involves options and the United Gas Fund. So I hope that was helpful. Thanks for stopping by. I hope everybody was green day. If you have comments, drop them below, and we'll see you next time.